Hello, option strat traders. Steve Gans here, sharing another trade concept with you. What I want to do today is I want to take a look at a chart pattern here, specifically in SPY. We can see that we've been making for quite some time now. We've been making lower highs in SPY, and we're bumping right against this trend line here today. Likewise, we have been making higher lows as well, and this creates what's called a flag pattern. Now, my premise for this trade is that we're going to maybe drop away from this trend line again. So technical analysis kind of tells me that that is certainly a possible scenario, maybe better than a 50% chance scenario, since that has happened multiple times before. In rare occasions, it can even kind of bump through that trend line and then fall off after that. So even if it bumps through here today, I'm not overly concerned about that. But again, my overall premise is that we're going to drop away from this 410 price range, maybe down. I mean, if we came all the way down to our uptrend line, that might drop all the way down to 390 or so. Again, I don't know that it'll make it all the way down there. I don't know that it's going to drop at all for that matter. But my premise surrounding this trade is that I will expect some sort of a drop, maybe down to this 400 or 395 range, somewhere in that vicinity. So if that is my premise, what sort of a trade might I consider here? So that's going to be a bearish type of trade. So I'm coming in and I'm looking at buying a lone long put. So let's just say I choose to buy a 410 put. Again, our market's currently trading right around 410. So I would be buying what's called the at the money put. If I were to buy that put right now, I'm going to spend about $7.51 or $751, as everyone should know. Each option represents 100 shares of stock. So if I'm buying that put for $7.51, that means I'm going to be paying $751 or $753 for it. And that will be my max loss in this trade. So if the market stays here where it is right now, or the market goes higher, I stand the chance of losing all of that money through what's called theta decay. Time is going to decay on me. In other words, I am making a trade here based on the assumption that the market is going to drop down into this 390, 395 range, somewhere down in here. If my premise is correct, I will achieve a decent profit on this trade. But the whole time, theta is going to be working against me. So let me take this back. This is, of course, our curve at expiration. Let me take this all the way back to, if we were to enter this trade today, we wouldn't be up or down any money. We would be down just whatever we paid for commissions. But over time, this dashed line, if we come and we look at this, the dashed line represents April 27th in this case, or 25 days out. Our dotted line represents expiration, so 33 days out. So on April 27th, if nothing happens at all, on April 27th, we're going to be down about $400 or so in just theta decay. So we have to understand that. So if we enter this trade, this needs to go in our favor fairly quickly. If we entered this trade and the market did in fact drop over the next couple days, we can start to earn some profit fairly fast. However, if we march forward in time and let's say nothing happens in this trade until 2 weeks from now, well, we'll be down $209 if the market is right where it is today and nothing else has changed. So we need this to go into our favor fairly quickly. That's what we would be hoping for. We would be hoping that within the next few days, maybe by the end of this week, early next, this starts to drop and goes in our favor. If that happens, two things we could consider doing. We could consider just letting that ride, and of course that can become a very profitable trade if the market sold off hard. Or if our premise is that the market's going to just pull back here to the 392 or 395 or 390 range, somewhere down in there, if that is our premise, then once the market starts to sell off a little bit, we can come in and we can sell a 395 or some other put against our long put. And what that does is that will essentially cap our downside gains. But look what it did to our max loss. It greatly reduced the amount that we were going to potentially risk in the max loss. It also moved our break-even point from around the 402 all the way up to 406. That's because we will take in premium when we go and sell this. So when we buy this option, it's a debit. We're paying out a chunk of money to own that single long put. Once that starts going in our favor, then we might consider selling an opposing put to that. I should also say that this is assuming the price that we would get right now. If this market were to start selling off considerably, we would get a lot more money for that 395 put, which would further reduce our risk on this side. I can't tell you how much right now. We don't have, there's no way of really knowing. It depends on how fast and how hard the market sells off. But if the market does sell off, be looking in your paper trade to model selling a put against that. So that will just reduce, again, your overall risk in the trade. In exchange for that, you are capping your maximum downside, because if we don't, when I say downside, that's actually capping our max profit to the downside. Because if we don't have that trade on there and this continues going down, 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 well, I mean, this is just going to continue to make more and more money. But again, if our premise is that we're going to go to the lower end of that wedge, then anytime we get anywhere kind of close in that general area, I'm fine going ahead and capping my profitability to the downside, because my opinion is we're not going to blow through that and continue moving down. So I'd like everyone to consider putting on a paper trade like this and seeing how this reacts over the next couple days. I would also tell you that if we get into a trade like this, let me exclude this one again. If we get into a trade like this does have to go in our favor, again, fairly quickly in order for us to make money. So if we get into this trade and our market either breaks out or doesn't start reversing on us maybe by late this week, you might want to consider just pulling the plug on that trade, because if we get a hard breakthrough here, that kind of tells us that our premise was wrong on this, and we just need to exit the trade and reduce our loss, or take a small loss. So anytime you're trading, you always want to take small losses, take larger gains when you can. So you got to just keep your losses small. So if our premise is proven wrong, again, our premise, we're going to buy this long put. Our premise is that the market's going to go down. If the market doesn't start dropping off this 410 range within 3 or 4 days, if we look at our expiration, let me just take this back to where we're only 4 days out, for example. So in 4 days, this won't have dropped much in value. If our market is still right about where it is, we shouldn't have lost much in value. If we break out to the upside and we get all the way up to 412, we could be down about $100 in this trade by the end of the week. Again, if that's the case and our premise is proven wrong, the market is not going to fall back down, just pull the plug on the trade. So that's going to be the best case scenario to get out of this with a small potential loss. So again, all the recommendations I make are paper trades. They're designed to help you see how options work and the dynamics of them in multiple directions. So I thank you for taking a look at this, and it should be a decent paper trade to consider, play with, learn from. Thank you.